Hey guys, welcome back to the channel. So if you're seeing this,
Dow plummeting 560 points, S&P plunging 2.45%, and the NASDAQ, sell. Nosediving 3.52%.
and you're thinking that this is coming,
We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
then I'm here to let you know that you might want to hold your horses and just let me explain what's going on for a minute. So over the past few days, the stock market has taken a tumble of around 3%, and it's been the entire stock market that's taken a hit. It's not just the growth stocks, although they have been hit the hardest. Shares of tech companies like Tesla, Apple and Zoom are down over 5%, some of them even over in the double figures. So what's going on? Is this the start of a market crash? Or is it something altogether different? Well, I'm going to explain that, but first, I have something I need you to do. I need you to go down there and just destroy the like button. Just smash the like button for the YouTube algorithm for me. Great. So now let me go through what's happening, why it's happening, and what you should be doing about it. So what is going on? Well, first, let me put a frame of reference into this whole stock market crash that people are talking about. So firstly, volatility in the stock market is extremely common. In fact, on average, pretty much every year since 1920, the stock market has pulled back by about 5%, 3 times a year. So small dips and changes of 3 to 5% are actually incredibly common. They're nothing to panic about. If you look at the 24-hour chart, the 1-week chart, the 6-month chart, and then the 5-year chart of things like the S&P 500 index, you realize that the volatility, or the apparent volatility, decreases as you increase your time frame. This is something to always remember, is that sure, the stock market might dip in the short term, but in the long term, stonks only go up. I'm just kidding, they don't actually only go up, but for the most part, the S&P 500 index over a 30-year period has always netted a positive return. So secondly, a larger correction in the market of say 10% is actually quite common as well. In the last 20 years, this has happened 11 times. And then even greater than these 10% corrections are when we fall into a bear market. So this is where we see a drop of 20% or more over a sustained period of time. But even these aren't that uncommon. They typically occur in rough cycles every 7 to 10 years, and they're no laughing matter. They're typically accompanied by difficulties in economic sectors, so you might see different countries around the world going into recession. And on average, during these bear periods, the stock market falls by 33% over the course of a year. And then after that, we have that next level fear that people think, which is a stock market crash. Now, there's no general definition on what a stock market crash is, but most people take it to be a drop in the stock market of over 40%. Throughout the last 120 years, an actual complete stock market crash has only happened 3 times. Once in 1929, once in 1979, and then once in 2009. So an actual stock market crash or collapse is rather uncommon. But then again, a global pandemic that shuts down the entire world is rather uncommon as well. So should we be worried? Is a stock market crash coming? Well, in order to answer this, we need to think about what category we fall into. And I'm going to give you the honest and complete truth about this. Nobody knows. The truth is, nobody can predict exactly what's going to happen with the stock market. There may be indicators that certain things are about to happen, but nobody can guarantee you that exactly what is going to happen is going to happen. So nobody actually knows whether we're about to have a stock market crash or not. And of course, we need to remember that frame of reference. A 1-week downturn in the stock market of 3% is just a normal correction, especially when we're coming from all-time highs. But what we do know as to what's going on with the stock market at the minute is that there is an almost unseen amount of volatility occurring due to the absolute shake-up caused by retail traders. Just take stocks like GameStop, AMC Entertainment, Nokia, and then of course on the other side, look at Dogecoin for instance. These individual stocks have been the action of Redditors over the past few weeks, and it's been interesting to see how much volatility that has produced in the stock market in general. And as a result of this, the whole stock market is feeling more emotional and irrational than ever before, which is why people start seeing a slight decline and they start panicking and thinking it's a stock market crash, I've got to pull out of all my positions. But this is something you need to remember that frame of reference for. It's not necessarily a stock market crash, it could just be those corrections we see 3 times a year of 5 to 10%. So as for what's actually happening, only 2 things are certain. Stocks have fallen pretty consistently over the past week or so, but that it's way too short a time frame and nobody knows exactly what is happening. So now we're going to go on to the why this is happening. Now, of course, as I just said earlier, retail traders and increased volatility in the market is having a huge factor. The massive pump and short squeeze of GameStop is fresh in everyone's minds, and the irrationality of that kind of movement in the market, of this whole get rich quick mentality, where people just pump a stock as much as they can and try and make money as quickly as they can, is something that is quite dangerous because it leads to a lot of volatility in the market that shouldn't necessarily be there. Next, of course, there's the overall fear that governments are just printing money like it's nothing. I mean, the American money printer is literally just going brrr at this point. It's crazy. This is leading to worldwide levels of debt which are completely unseen, which is creating more and more concern and a bit of fear in the stock market in general. If you want to see a breakdown of how worldwide debt is affecting the world and what dangers it could bring, then I'll link my video up there somewhere. And then additionally, on top of this, traders are getting nervous over the potential increase in inflation and interest rates. Now this is because in general, higher interest and inflation rates means lower earnings and stock prices for companies, which means that on the whole, the stock market may start to shift in a downward trend as these inflation and interest rates increase. So the interest rate that we're talking about here that affects stock prices is the federal funds rate, or the discount rate. This is the rate that institutions are charged for borrowing money from the Federal Reserve or from the bank. So the reason that this affects business negatively is that as that interest rate increases, it costs more money to borrow money from the reserve. So companies do this quite often in order to fund different ventures or R&D and growth. If they can't fund that growth as cheaply as they have been able to, then we might see a decrease in the growth of these companies. And in short, that basically means that their share prices are likely to fall because their earnings reports won't be as impressive. On top of this, this means a rise in credit card and mortgage interest rates, which means that people like us have less to spend. If we have less to spend, we're putting less cash into the economy, less cash into those businesses, and so that causes their earnings reports to fall even more. So as a result of that, you get that compound impact of directly impacting the bank balance of the company, and then also impacting the consumer's bank balances, which directly impacts the companies because we're not spending as much. So across the potential for interest rates to rise, that is one big thing that is causing uncertainty in the markets, and the possibility of interest and inflation rates increasing has been the main factor in what has driven this downward trend in the stock market over the past few days. So now that we know what's going on and we know why it's going on, what should you do about it? So as people say over and over again, buy the dip. And this is genuinely true. When the stock market decreases, everything's on sale. You can get stocks that you would have thought about buying before cheaper than before. Now remember, this could be a correction of 3 to 5%, or it could be a market crash, so you don't know how low the dip is going to go. But at the end of the day, it means you can buy stocks cheaper than you have been able to for the past couple of weeks. So that's a good thing for most people. Now, as I said, we don't know where the bottom of this dip is going to be. It could be 5, 10, 20, 30, 40% dip in the stock market. But because we don't know where the bottom of the dip is going to be, we have to be careful and consider how we're going to enter into positions. After all, if you throw all your money in now thinking you're buying the dip and it drops 20 or 30%, you've lost quite a significant chunk of money and you'll have to wait quite a long time to get that back. Now, that's not the end of the world, but similarly, if this is the bottom of the dip already and it starts correcting and you don't buy in waiting for it to dip more, you might lose out on some potential returns. So this is where you should be scaling into your positions. Now, this is something I have discussed before in a collaboration with Stan, which I'll link up there and also in the description. But scaling into positions, you can also use as dollar cost averaging, but basically just buy in regularly at whatever the price is in a certain stock so long as it's below a threshold you set yourself. So for myself, for example, I've split out the amount that I want to invest over the next 2 months into weekly blocks, and then every week I'm just going to invest at the same time and just buy, and I'll do that for the next 8 weeks, and I'm not going to look at what the stock price is at that point. I'm just going to make sure that my average cost is going to be decreasing if the stock market decreases, which means I'm more likely to have an average closer to the bottom of the dip than I am if I just waited and completely mistimed it at all. So the key is to not panic. The stock market experiences corrections and little downturns all the time, but over a long enough time frame, and we should be investing over a long time frame, the stock market returns. As I said, over a 30-year period, the S&P 500 index, for example, has never not yielded positive returns. So I think the most important thing you can do is not panic and just stick to your investing strategy. If you have something you've researched and you know and believe in, and you stick to it, then regardless of the outcome, you've done what you think is correct, and you've done your analysis. At the end of the day, investing is your own decision. This is completely your own choice. So if you stick to what you believe in and what you think will give you good returns, then hopefully it works for you. And if it doesn't, at least you have your integrity and you can learn from it and try to develop a better strategy for next time. So that's my breakdown of what's going on. Now, as I said at the start of the video, please smash the like button for the YouTube algorithm. Leave a comment on whether you think this is going to be a stock market crash or not. Subscribe if you are new around here, and I'll see you in the next video.